Joining us now to talk more about today's jobs report and what it says about the health of the U.S. economy, Stephen Whiting. He's Global Chief Strategist with Citi Private Bank, and Kevin Cummins, Senior Economist at UBS. And Stephen and Kevin, thank you so much for joining us. Stephen, let me begin with you. You heard our report. What is the message of this employment news today? Is it a fluke? Is the number a fluke, or something more serious going on? What do you think?
Well, I mean, the sad truth is the U.S. or most large economies can't measure what employment will do on a month-to-month basis. These are statistical samples that are extrapolated, and then you heavily manipulate them with seasonal adjustment. What I think is meaningful from this report is that, back in 2008, we had 155 million people available to look for work or working. Today, we have 156 million. The unemployment rate has fallen from 10 to 6%. As you heard earlier in the program, unfilled job openings are now the highest level since 2001, yet the U.S. labor force really hasn't budged. We have been tightening labor markets at rather moderate or slow GDP growth rates, and that's suggesting some future limits. We should not be expecting a big acceleration in employment growth for what has been strong now going on a fourth year.
So, Kevin, let me pick up on something Stephen just mentioned, and that is unfilled job openings at a high level. Is it because we just don't have enough skilled workers to fill those jobs? What gives here?
Yeah, well, the labor market, I'd take a little bit more of an optimistic outlook for the U.S. economy in that we're creating over 200,000 jobs a month. So far this year, you've averaged 215,000 jobs. That's going to continue to push the unemployment rate lower. Admittedly, some of the drop in the unemployment rate reflects those dropping out of the labor force. But as the labor market has picked up some momentum this year, you're likely to see a little bit of a pickup in the number of people coming back into the labor force, so that you're really probably going to stabilize going forward from your labor force participation rate. The sort of job growth that we're getting is going to put more than enough downward pressure on the unemployment rate where you start to see a pickup in wages. And that's one of the missing ingredients here that you touched on in your earlier spot. And I think that's going to likely help the consumer and get GDP growth going more towards 3% going forward and back away from the 2% that we've had so far in the recovery.
Well, I'd like to pick up on that 3% GDP growth. Stephen, let me ask you
Yes.
this. I mean, a lot of people are thinking that it's 3% now, maybe it'll go higher. There's going to be a real pickup. The economy is just going to take off, and with it, the stock market.
Right.
Is that how you see it? Is this kind of the new speed limit for the economy?
Well, I think we can have 3% GDP growth in the coming year. We can certainly do a lot better than this first half average with the negative first quarter and 1%. But the idea that there is a recovery that's still ahead of us that we haven't already been quite deep into, I think is a mistake. I think if you look at labor markets, the pace of declines, the trajectory of declines in the unemployment rate has been suggesting that the economy has already been growing above trend for some time. So you don't, for example, shouldn't expect employment to go from a 200,000 monthly pace or a little bit above that, as we've seen over the past 12 months, to a 300,000 number or some tremendous gain from here. We are already there, and this is what a recovery looks like.
So, Kevin, what do you think the normal rate of growth for the U.S. economy will be over the next decade or so?
Well, there's been a lot of discussion here, and it's an active debate. And there's a lot of variables that are very difficult to forecast to make that assumption about potential GDP growth. And I can sympathize with the idea that it's come down some. But I think a lot of the kind of doomsayers, I think that's a bit backward looking. If you think about it more recently, you've had a massive fiscal tightening. That's not something that's going to happen going forward.
Is it closer to 3% or closer to 2%? Kevin?
I'd argue closer to 3%, yeah.
Stephen, let me just...
And the other part was the deleveraging. The consumer has delevered, and I think we're back at a spot. If you look at, debt to income ratios are in a healthy position now. You've had a higher savings rate.
All right, I'm sorry to cut you off. I just want to get one last comment from Stephen before we wrap this up here. You kind of worry me with your outlook of what's going on. So as an investor, I'm sort of wondering, like, what do I do with my money? How do I protect myself? I mean, what are you telling your clients over at Citi?
You know, I would be aware. Right now, I think we are well cyclically positioned. Again, there's no obstacles to growth within the coming year. We're overweight equities and moderately underweight fixed income. We're overweight credit and prefer that over the rate market. But I think our asset allocation, we should just not assume that this sort of thing can stay here. That 3 years from now, there may be some meaningful limits to the U.S. recovery. If you think about what has slowed the labor force, there's been nothing from the demographic side that has already effectively slowed the labor force. I've been an optimist since 2009 and waiting for a long time for that labor force recovery.
All right, it's a conversation we would love to continue. A lot to talk about on. Thank you so much, gentlemen. Stephen Whiting with Citi Private Bank
Thank you.
and Kevin Cummins with UBS. Thanks so much.